We here at FreightWaves continue to follow a developing story that happened over the weekend. On Saturday, officials say that a crucial Saudi oil field was attacked by drones, knocking out about 5% of our world's oil supply. This is big news. The markets have not opened yet. Craig Fuller joins me now, the CEO of FreightWaves. But we're continuing to watch this because the price of crude oil has just spiked, meaning we need to watch out what this is going to mean for the freight industry. Talk about that.
Yeah, so the domestic markets have not opened. Asia, we saw trading in Asia, but we've not seen it yet in the U.S. The time we're filming this, so it's unknown what the markets are going to do, but we do have some indication on how the Asian markets open. We saw initially, there was an initial market reaction, and again, shorts are covering, so a lot of that's just everybody getting out before it gets really bad. A lot of electronic triggers happened with stop losses, but we saw a surge of around 19% on Brent. And so there was a lot of activity happening in the market, which was quite concerning. In fact, I wrote an article yesterday afternoon. We saw that happen. We talked about what if that held, what it would actually do to diesel prices. Mm-hmm. You could have seen or could see a 60-cent a gallon increase in diesel. Now, the good news is over the last couple of hours, and again, the U.S. domestic markets have not opened, but over the last couple of hours, we've seen that sort of pull back a bit, and it's about half. The other thing that's happened is that the diesel price, in terms of the ULSD contracts, had jumped as much as 20 cents a gallon. They're down to about 15 cents. So if we actually look at this, I want to show what is happening with the WTI. Now, the WTI is West Texas Intermediate oil contract, and basically it is a contract traded based on the price of what oil is out of the ground, at the central hub related to Texas, but the Cushing. So right here, it was trading prior to the weekend at 57 and 30 cents. 37 cents a barrel. And if you think about the fact that it's right now in Asian markets and in European markets over $60 a barrel, that puts us back to where we were in sort of midsummer. So, we're not talking about catastrophic outcomes. The more catastrophic effect is really when oil prices spike and diesel prices spike, because trucking companies depend on fuel surcharges. So if we go to the next chart, I want to show really where we'll see this show up is at the retail locations at the truck stops. And you can see prior to Friday, so we measure this price every single day. Okay. So the DOE, which we'll talk about in a second, the Department of Energy average retail price is a weekly measurement, and it really reports what happened last week. This reports what happens daily. But when we left on Friday, enjoying our long weekend for football, it was $2.98 a gallon, or $97.59 a gallon. So, it had actually come back and had gone up a little bit in September. We saw a little bit of increase, but nothing substantial. In fact, if you go back to last year, we were talking about being over about $3.25 a gallon. So big increases. Now, when this attack happened and trading started in Asia, if you had considered a 20% increase, would have put us about 360, which would have been bigger than anything we saw over the last 24 months. So would have been very, very concerning. The good news is that it seems to has pared back a bit. Now, what will happen is there will be some surge. There will be some increase. It's probably around anywhere from 15 to 18 cents a gallon from what we're seeing right now. We just don't know. Until the market's open and set, we won't know that. But we will see some increase. We could see we'll be back to where we were in late fourth quarter last year. If we go to the next chart, I want to show what actually happens when the DOE. So keep in mind, trucking companies have fuel surcharges. And the trucking companies' fuel surcharges are set basically on a weekly assessment, which means that the Department of Energy goes out and measures the price of diesel at all the truck stops. And you can actually see right here is this is what they're measuring, so it's very close to the diesel truck stop average. It's because there wasn't a lot of movement. When that comes out at 5 p.m. today, it won't reflect any of the increases that happened related to the Saudi attack. So it's something to watch and see what happens. So certainly as we think about it, This is an important number and really will impact how carriers recover a lot of their fuel costs.
When you talk about anywhere from a 15 to 18 cent per gallon diesel increase, does that make a difference in the trucking industry?
Oh, absolutely. Because if you think about trucking companies are getting 6 to 7 miles per gallon, then a 15-cent increase is about 2 cents a mile of cost, direct cost. And if you're operating a business at say 4% margins, 3 to 4% margins, then that 2% cost is a lot of your margin, and that goes direct to the bottom line. Now, a lot of times the trucking companies will actually recover a lot of that cost with fuel surcharges, but the challenge is when you have a spike that happened over the weekend, they won't have the opportunity to recover it until the following week. And so any increase that takes place this week that isn't sustained won't actually help them in terms of the assessment. So let's go to the next chart. I want to show a couple more things. So one of the things that happens is the larger enterprise trucking companies basically buy on rack. Okay. And what rack means is it's the wholesale price. They're actually buying on what the wholesale price of diesel is, not on retail. So when you and I, if we owned a truck or we own a car, we pull up to the pump, we're going to pay whatever the pump says we pay because we just don't have any buying power. Bigger trucking companies, usually starting about 25 trucks and up, are buying on rack wholesale prices, which means they're buying based on this number. Now you'll notice that there's we're at $1.97 here. If you recall, on the wholesale price, the retail price, about $2.98. Yeah. It's about $1 a gallon. Keep in mind that things like taxes and transportation costs to get it there are not assessed in there. But this is going to move really quick, so will retail. And so if we go to the next chart, I want to show something in terms of how this works. This is a chart comparing the retail price right here, yes, the green line, to the wholesale price. And what happens is when there's a big spike in the wholesale price, you tend to see the truck stops react faster. They increase their prices really, really quick. When the price comes down, they're much slower to actually react to that. So what will happen is this spike that happens, even if it's short-lived, a couple of weeks, that price may stay high at the pump and not be passed on, may not show up in the rack prices. So the larger carriers will be the beneficiaries. The smaller guys that are paying retail will be impacted. And one of the indexes that we've created to the next chart is called the spread. This actually measures the delta, the difference between the retail and wholesale prices. And the reason we do that is it lets you see sort of how these move. And if you look last year, we were around 80 cents a gallon in the spread. This year, we're about $1 a gallon right now is what we're setting. And we saw in the summer that we're as high as $1.10. And then last fourth quarter, I mean, look at this right here. You were up to about $1.30. And what that means is that the bigger companies are paying a lot less versus what the smaller guys are doing when they're buying retail diesel.
And you're talking about the smaller carriers being affected more than the larger carriers in this.
Well, everybody will be impacted over the next week.
Okay.
So but everyone is going to be impacted over the next week because they're not able to pass those surcharges on because it won't show up in the DOE number. But absolutely, the impact of diesel surges and spikes impacts the smaller carriers disproportionately that it impacts the larger carriers.
This hasn't been a great past few months for trucking either. And so could this be an even worse issue for these smaller carriers that have been struggling?
Absolutely, because you keep in mind, and we actually did a study what causes bankruptcies, what predicts bankruptcies, and it's large spikes in diesel. A gradual build in diesel prices doesn't wash out the carriers. It's when you have huge spikes that are unanticipated. And this was when the market opened, it was the largest spike in oil prices since the Gulf War. I mean, we're talking about a major and significant black swan event that happened over the weekend. So any carriers that are teetering are gonna be struggling because they're not gonna be able to recover that price. They're not gonna be able to recover the cost of diesel, which hits their direct bottom line. That's going to be impactful. Like we said, it's going to be a couple of pennies a mile. It could have if the 60 cents had sustained, which for now looks like it didn't. goes as much as 9 cents a mile. And that's a lot of cost that those guys will have to bear. The good news is that doesn't appear to be the case. We're talking about 2 to 3 cents per mile additional cost. That is not unmanageable. It just is more difficult to manage and something to watch.
You're talking about a spike in diesel being one of the precursors or one thing that actually makes a company go bankrupt. Is this enough of a spike potentially to, in a few months, we see more companies closing?
You know, a 1 week spike, probably not.
Okay.
It's the end of the third quarter, which is relates to spot rates. It's a good time. And if we're talking a 2 to 3 cent spike, I think we're okay. I think a lot of the carriers, small and big, will be able to sustain it because the 2 to 3 cent a mile increase in cost at the end of the third quarter they're likely to benefit from higher spot rates. They're likely to benefit from just better conditions than we've seen. So I don't think 2 to 3 cents in a 1 week spike is really worrisome for the market. The bigger question is what happens long term. And so Saudi, the infrastructure, half of their production's been knocked out. That's 5% of the global oil production. The question is going to be, how long does it take them to repair the facility and bring production back online? And then the bigger question is, what does this mean geopolitically? Do we end up going to war?
Yeah.
Like a war could completely change everything. Do we end up going into a surgical attack? Does this cause, the thing that happened, you think about the fact that there were no troops involved.
Yes.
There was apparently cruise missiles and drones, no humans. That's what makes it so scary from an infrastructure standpoint, because these drones they're using aren't that expensive.
No, and they're easily manufactured. I was listening to some officials on the radio today, and it's one of those things where you didn't have to worry before about attacks like this, but now with the high-tech stuff like a drone coming in and easily going past things, it's just, something you have to worry
Saudi Arabia
about.
has really good air radar,
Yes.
relatively good, supplied by the U.S. government
Yeah.
and the U.S. military. And so the challenge is that these drones, and you can send them out if you don't care about the repercussions. The issue is, what if a terrorist organization gets a hold of them and takes out some of our critical infrastructure? So one of the things I was talking to John Kingston, who's our oil expert this morning, is that for the large part, the risk premium that's involved in the oil markets for only the last 30 years has been this premium put on oil related to just geopolitical risk. That's really been taken out of the market over the last couple of years. We're now seeing that return. And so you're going to see oil prices have a little bit of higher cost than what the market is, just because of the risks of an event like this happening. Now, the president's come out and talked about tapping the strategic reserve. If that will calm the markets to a degree. And I think domestically there is, I don't want to say it's upside in this. Luckily, there's no, my casualties seem to be de minimis. They don't seem to be significant. So that's good. But in terms of upside for U.S. domestic fracking and railroads and actually trucking, should increase demand of those U.S. supplies. It also may take away some of the political pressure that you see on the campaign trails of people wanting to get rid of fracking, because we need domestic energy. And so it actually may increase development. And if the oil price stays in the $65, $70 a barrel, then that will encourage speculation and building and wildcatting out in Texas.
Yeah, still a lot of unknowns on this Monday morning, but we will continue to watch this. Of course, it is a developing story, so stay with FreightWaves.com.